Welcome to Mind Your Money. I'm Allie Canal, and this is Yahoo Finance's flagship personal finance show. Think of this as your financial toolbox. For the next 30 minutes, we'll give you the latest money news, cut through the jargon, and tap into expert advice, all designed to help you take control and build a stronger, healthier financial future. On today's show, we go through all the key ways the Federal Reserve's latest rate cut could impact your money. First, we'll look at what lower rates means for your savings accounts and your credit cards. Then we'll look at how lower policy rates really affect mortgages. Plus, an expert shares 6 saving trends that really work later on in the show. The Federal Reserve just delivered a long-awaited quarter-point rate cut this week, but what does that actually mean for your money? It can affect everything from your bank accounts to loans to credit cards and even your investments. I'm joined now by Yahoo Finance personal finance editor Casey Bond to break it all down. So Casey, let's start with the basics here. How does a Fed rate cut affect checking and savings accounts?
Sure. Well, checking and savings account rates are set by individual financial institutions based on a number of factors. That includes market competition, whether or not they want to encourage more deposits. But in general, they also do follow the federal funds rate. So when the Fed raises or lower rates, savings and checking accounts tend to fall in line with those movements. With this recent rate cut, it was a modest one, so we shouldn't expect rates to change too dramatically. But the best savings account rates in particular have hovered around 4% APY, so we may see fewer accounts offering rates that high.
And what about certificates of deposits, otherwise known as CDs? How would this cut maybe affect those types of savings?
Sure. Well, similar to savings and checking accounts, CD rates also are tied to the federal funds rate. So with this most recent cut, we can expect those rates to start coming down. The unique benefit of a CD, however, is that it allows you to earn a guaranteed rate through the entire term, whether you choose, 6 months, 1 year, 2 year. So if you know that rates are going to be falling and there are additional cuts on the table for 2025, it's a great strategy to put your savings into a CD and lock in that higher rate now. So as rates fall, you're still earning a more competitive rate.
And how do personal loans change when rates come down?
Sure. Well, personal loans are typically one of the more affordable financing options, whether you're looking to consolidate credit card debt or, finance a large purchase. And in recent years, the average rate has hovered around 12%. So again, with the recent federal funds rate cut, we can expect that rate to drop slightly. But it is important to note that personal loan rates are tied to the individual applicant's credit as well. So those who have good to excellent credit are really the ones who are going to achieve the best rates available, even into the high single digits.
You mentioned credit card debt, and let's stick to the borrowing conversation. What happens to credit card rates in this type of environment?
Sure. So when it comes to credit card rates, those are very closely tied to the prime rate, which is basically the interest rate that banks reserve for their most creditworthy customers. Of course, that prime rate is also tied to the federal funds rate. So there is a correlation between the Fed's target rate and credit card rates. Credit cards remain one of the most expensive borrowing options today. And lately, the average rate has hovered around 22%. So even if rates do come down a little bit, it's still not great to carry a lot of credit card debt. And it's a great of time as any to look into ways to consolidate and lower that rate, whether it's through a personal loan or even a 0% APR balance transfer card.
And finally, Casey, how does the Fed's interest rate policy filter through to investments for everyday Americans?
Sure. Well, Fed rate cuts are generally good news for the market. When it costs less to borrow money, companies can afford to spend more money on, daily operations and expansion, and that translate to higher stock values. So in the coming days, many investors will probably see their investment values tick upward. It is important to note, however, that investing is really a long-term play. So you should be basing those decisions around having, a well-diversified portfolio, your time horizon, your risk tolerance, and not so much what the Fed is doing day to day.
Casey, some great advice there. Thanks so much. Appreciate it.
Yeah, thank you.
Well, as expected, the Federal Reserve cut rates by a quarter point at its September meeting, bringing the benchmark policy rate down to 4.25%. Now, mortgage rates aren't directly tied to the Fed's move, but the benchmark rate can influence them. To break down what this means for home buyers, I'm joined by Yahoo Finance housing reporter Claire Boston. So, Claire, mortgage rates are now at their lowest level since October of last year. Should we expect them to shift at all following this latest decision?
Yeah, Allie, so we're actually starting to see them shift already, and unfortunately things are not going the way that we had hoped.
No!
Mortgage rates started to rise a little bit yesterday, and then today they are up about 15 basis points more. Not what we want to see, but we talk a lot on this show about how mortgage rates are really tied to that 10-year Treasury, and Treasury yields have been rising, based on new economic data, and also people looking at what Fed Chair Powell was saying yesterday and thinking, okay, I'm not seeing that they're going to cut rates a zillion more times this year. It may only be a few times. Powell was talking about economic uncertainty, and so it's a little unclear kind of what the path is from here.
Yeah, he was really emphasizing a lot of those risks, but the Fed did signal 2 more rate cuts from here, another one penciled in for 2026. How much of that, though, has already been baked into mortgage rates?
Yeah, I think some of it was definitely already in there. It was the base case that we were going to get these additional 2 potential rate cuts this year. I think from here we really have to look at what economic data do we get. Is it showing that the job market is weakening or strengthening? And, in those cases, those little economic data releases can really cause Treasury yields and mortgage rates to move a lot given these uncertain times.
Now, with rates back closer to 6%, National Association of Realtors chief economist Lawrence Yun, he told Yahoo Finance that's a good thing for buyers. So I wanted to take a listen to what he had to say.
This is a great news for potential home buyers who have been priced out, but now with lower rates, their purchasing power increases, and we expect more buyers to begin to knock on the door.
So, Claire, how much are these lower rates driving some uptick in activity in the housing market right now?
Yeah, I think on the purchase side, it's a little bit too early to tell. Given that rates are still in this 6% area, it's still pretty hard to afford a home. But what we are seeing is a little bit of a refinancing surge. Last week, refinancings were up 58%. So, I think that's a really clear sign that people are paying attention. They are seeing that rates have fallen quite a bit in recent weeks. And, for those people that are at the 7% mortgage area or higher, they're definitely what we would call in the money for a refi, meaning that, the savings would pay for itself pretty quickly.
And for those would-be home buyers still sitting on the sidelines here, is it too late to take advantage of these lower rates?
Yeah, so I think it depends, what will happen in the coming weeks. That being said, when I talk to people like mortgage brokers, they say over and over again, it's really hard to time the market. Don't try to do it. When you are ready to buy a home, buy then, regardless of where the rates are. Refinancing is an option should rates fall, but otherwise, you might be waiting if you're trying to, hit some magic number there.
Yes, and that's advice that I feel like I've been giving to my friends, a lot of those home buyers that or would-be home buyers that want to enter this complicated market. But Claire, thank you so much. Appreciate it.
Thank you.
And you can scan the QR code below for all of Yahoo Finance's mortgage rate coverage. And with mortgage rates at their lowest level since October 2024, many potential buyers may be wondering, is now the right time to buy a home? Here to break down the factors to consider is Yahoo Finance personal finance lead editor and content strategist for mortgages, Laura Grace Tarpley. So Laura Grace, let's start with the upside. What are some of the positive signs in the housing market right now?
Hi, Allie. So some of the positive signs that it could be a good time to buy a house are kind of what we've been talking about, which is that weekly mortgage rates have been steadily decreasing. And according to Freddie Mac, are at their lowest rate in almost a year. So lower mortgage rate means lower mortgage payment. There are also a lot of factors in the housing market that are giving buyers more power than that they've had in a few years. So more homes are for sale. According to data from Realtor.com, from August 2024 to August 2025, 21% more homes are for sale. And these houses are staying on the market for longer. The typical house is on the market for 60 days right now. That is a week longer than this time last year. And a lot of people might remember 2021, 2022, when you would feel lucky if a house was on the market for a week or even a few days. And also in those years, a lot of people had to offer way over asking price to have their offer accepted because the market was so competitive. And so now sellers are listing their homes for a lot of money and then realizing that, they're not in a 2022 market anymore and they can't price their homes that way. So they're cutting their home prices. And last month, 20% of home listings experienced a price cut. And overall, home prices are just kind of calming down a little bit. Home prices have fallen or stagnated in 39 of the US's 50 largest metro areas last month. So this is all good news for buyers. It means that they don't have to rush as much as they used to. And it also gives them more negotiating power so that they can get a better price. And hopefully buying a home is more affordable than it has been over the last several years.
All right, so some positive signs there. On the flip side, though, are there still reasons to be a little more cautious?
Yes, so things are improving, but they're not perfect. So mortgage rates have been decreasing weekly, but they are still not as low as I'm sure a lot of consumers would like. They are a little bit higher than they were last September. And like Claire was saying, there's really no guarantee that just because the Fed cut its rate that mortgage rates are also going to decrease. And people might just need to know that the low to mid 6% range could be the new normal. And they just need to factor that into their budget when they're deciding if they can afford to buy a home right now. Also, more homes are for sale, but inventory is still lower in most major metro areas than it was before the pandemic. So there's still a bit of a housing shortage. These are things that could be barriers for people wanting to buy right now.
So then, Laura Grace, what's the number one question a buyer should ask themselves before starting this process, which can be a little complicated?
Yeah, I think the biggest question to ask yourself is, where do I want to be in 5 years? If you can see yourself living where you are now in 5 years or more, then it could be a good time to buy a house. Because in general, it does become more expensive to buy a house as time goes on. So it could be good to get in the door now. But if you think you could move in the next year or two, it's probably not a good time to buy because buying a house is expensive and you wouldn't recuperate those costs if you're not going to stay in the house for a while.
And final question here, when it comes to the numbers, what are the key financial factors people need to weigh before making a decision to move or purchase a home?
Yeah, when it comes to financial factors, your income and how it can affect things like your down payment is a big one. So on your income, can you afford a down payment on a house in your area? Thankfully, a lot of mortgage lenders will accept down payments as low as 3% on conventional mortgages. But you should also think about whether your income allows you to comfortably afford the closing costs that you will pay upfront and your ongoing monthly mortgage payment. Also, consider your debt levels. Adding a monthly mortgage payment is a big undertaking. If you already have a lot of debt that's kind of overwhelming you, then adding on a monthly mortgage payment could just be too much. So instead, you might want to spend the next year or two aggressively paying off that other debt. So then you are in a better place financially to buy later. And the last thing is your credit score. The minimum credit score you need to buy a house really depends on which type of mortgage you get. But in general, having a higher credit score just opens more doors for borrowers. And mortgage lenders tend to reward a higher credit score with a lower interest rate.
All right, Laura Grace, thank you so much. Hopefully more positive news to come in the housing market.
Yes, thank you, Allie.
Well, coming up, Gen Z are amazing savers, according to recent data. We give you the 6 trends that will help you save like a Zoomer next on Mind Your Money. Gen Z are gifted savers. About 20% of the generation, that's ages 13 to 28, are already saving for retirement, according to a new report from TIAA. And it's not just retirement. Younger Americans are also putting money aside for emergencies. So how are they doing it? Here are a few key savings trends from Gen Z that you might want to add to your own financial toolkit. First up, the envelope method, also known as cash stuffing. It's a simple strategy. Divide your cash into different envelopes labeled for things like food, fun, or travel. And once that envelope is empty, your spending stops. Second, automation and AI. Brendan Tiergartner, a certified financial planner at Fidato Wealth, told Yahoo Finance, quote, Gen Z blends technology into their money habits as they are the first generation of digital natives. Finally, Gen Z also makes savings fun. They're gamifying it with things like no buy months, the 52-week savings challenge, and other goals that keep money top of mind. So, how well do Gen Z's favorite saving strategies really work, and how can you add them to your own toolkit? Joining me now is Brennan Tiergardner, Associate Wealth Advisor and Financial Planning Specialist at Fidato Wealth. So, Brennan, let's walk through some of these trends and get your take. First up, let's talk the envelope method. Is this a worthy saving strategy in your view?
Yeah, the envelope method has been around for decades. It's been around for generations. People have been using it for quite a while. The whole point of it is really to get that pain aspect of spending. So when you spend now, you're swiping a card and it doesn't really feel like you're spending the money. In order to try to limit the amount of spending that's going on, you put it in the envelopes, you take the cash out, you go spend the cash. So in that end, when you're paying in cash, you tend to not only spend less, but you know where every dollar is going. So that can help you try to mentally track, but also be able to have type of a guideline of knowing where the dollars are going and try to limit how much you're actually spending.
And Gen Z is also leaning on AI to help with money management, which is interesting to me. What kind of tools are they using, and how can savers make sure that they're picking the right one for them?
Yeah, so with the introduction of AI, really different types of saving strategies have really blown up across the internet. Prior to AI, there's different types of apps where you can save spare change, you can automate savings weekly, daily, monthly, however really you want to do it. But with AI, there's different types of robo-advisors now where you can essentially create a portfolio, or AI creates the portfolio for you. And it just makes saving just so much easier for people that don't really want to do it, because there's a lot of people that want to take a DIY approach to saving. And then there's other people that are like, I don't really understand it, and I'm not going to do it because I don't understand it. So instead, taking that next step to a robo-advisor just to get your feet wet in that saving aspect, but also automating so that way you don't have to go into and manually make those savings. So that way you can have it coming out of maybe your paycheck, so you don't even see the dollars, but basically getting it out so that way you don't have to worry about it.
Another trend I want to get your take on, because we see all over TikTok savings challenges. Do these really work in practice? And what are some of the top challenges that are making their way through some of those Gen Z savers?
Yeah, so with those types of challenges, they tend to work at least in the short term. So really, when you're saving, you want to be able to have some type of goal that you're striving to. With these type of challenges, it's more like, hey, I've done this or I've done that to be able to save this much. Really, there needs to be a goal behind the why you are saving. And saving itself is good, but you also want to make sure that there's a goal, there's a why behind you saving.
Well, Brennan, thanks so much. I'm going to have to start saving more like Gen Z savers do. Appreciate it.
Thank you.
It's time now for our weekly segment, Ask Yahoo Finance Anything, where we take your questions and answer them on air. This week, I'm joined by Bob Powell, host of the Decoding Retirement podcast. So Bob, let's get right into it. One Yahoo Finance reader asks, many advisors tell me to wait to claim Social Security until age 70, but are there cases when I should consider claiming early at, say, full retirement age or even earlier?
Yeah, so Allie, there are some cases where claiming earlier makes sense. So, for example, if you retire early because of health issues or physically demanding work and don't have enough savings or income to cover your expenses, starting Social Security early may be necessary. And then some people also find peace of mind in having steady guaranteed incomes right away, even if it reduces their lifetime benefit. So there's a case where you might want to claim early. And others still may have like serious health concerns and don't expect to live long enough to benefit from delaying. And then there's another group of people who worry about the future of the Social Security Trust Fund and prefer to collect Social Security early now rather than later to risk a benefit cut later. So while waiting often is best for people with a long life expectancy and enough assets to bridge the gap, there are some times when claiming early makes sense.
And another related question here, Bob. This reader asks, if I delay taking Social Security to age 70, how can I make the difference between what I would have received and what I need?
Yeah, this is a great question. If you want to wait until age 70 to claim Social Security benefits, it's typically likely that you'll need to have some income to fill that gap. And that's called a bridge strategy. So you can use your savings from your IRA, draw down from your investments. Maybe you buy an annuity to cover expenses until those bigger checks come in. The research shows that this can actually boost your lifetime spending power and help your money last longer because once you reach age 70, you lock in a much higher benefit for life. The big trick is figuring out how big a bridge you need and the best way to build it.
All right, next question here. I'm expecting an inheritance in the not so distant future. What should I consider?
Yeah, another great question. First off, don't rush into any decisions. It's recommended that you do absolutely nothing for at least 3 to 6 months to allow yourself time to process this new situation and avoid making any rash decisions. The second on the list is assemble a team of professionals. Hire a trust attorney, a financial planner, an accountant, and this team together can help you build out a long-term plan for the money that you're about to receive. And then in addition to building out that team, you need to define your goals. Before you invest any money, you should define what you want, your charitable inclinations, your commitments to family. And this team can help you with, all of this, figure out everything that you need to do to put in place for an investment plan. And then lastly, think about keeping things private. This may be hard to do, but you want to try and keep the news to yourself to avoid pressure from family members or others who may feel entitled to a portion of your inheritance.
Finally, our last question of the day. I have an opportunity to do an in-plan Roth conversion. What do I need to know?
So this is a strategy that allows you to transfer money that's in your traditional retirement account, like a 401k typically, or 403b, into a Roth account within the same plan. And the main benefit of this is the converted assets will then grow tax-free, and you can make tax-free withdrawals in retirement. The big drawback is this conversion triggers a tax liability. All the money that comes out of that 401k, for instance, or 403b, you'll have to pay income tax on the amount that you convert. So it's important to think about before you do this that you have money set aside to pay for the tax liability. But this is a good way to create money that eventually will come out of your accounts tax-free when you do withdraw it.
We had some great questions and answers there, Bob. Thank you so much as always.
Thank you, Allie.
Well, that's it for Mind Your Money. Scan the QR code below to sign up for the Mind Your Money newsletter and stay tuned for Market Domination that's coming up next.